The United States government owes $36 trillion, a number so incomprehensibly large that if you tried to count to it $1 per second, you'd be counting for over 1 million years. And every single day that debt grows by another $7 billion, piling interest upon interest in a spiral that mathematicians would call exponential and historians would call terminal. Yet somehow the dollar remains the world's reserve currency. Treasury bonds are still considered the safest investment on earth, and America continues to borrow at rates that would have destroyed any other nation in history. But here's what keeps Treasury secretaries awake at 3 in the morning. What whispers through the marble halls of the Federal Reserve? What haunts every economic advisor who understands the mathematics of what's coming? There will be a moment, perhaps tomorrow, perhaps in 5 years, perhaps in a decade, when the world stops believing in America's ability to service this debt. When foreign creditors start demanding real assets instead of paper promises, when the confidence game that has sustained American economic hegemony since 1944 finally breaks, and when that moment comes, when the debt crisis can no longer be papered over with more borrowing and more money printing, there are exactly 7 strategies that America could deploy, 7 shocking, unprecedented, ways that gold and cryptocurrency could be weaponized not to solve the debt crisis but to mask it, to buy time, to shift the burden, to create the illusion of solvency while the fundamentals continue to deteriorate. These aren't solutions, they're sophisticated financial magic tricks. And understanding them requires us to journey through the collapse of Rome's currency, the Spanish Empire's silver catastrophe, Britain's gold standard abandonment, and the secret architecture of how empires throughout history have tried to hide their insolvency until the very last possible moment. Let us start with the first and most audacious strategy, a strategic gold revaluation, where the United States government officially revalues its gold reserves from the current accounting fiction of $42 per ounce to something approaching market prices, instantly creating trillions of dollars in paper wealth that could theoretically be used to pay down debt. Now, to understand why this matters and why it's both brilliant and desperate, you need to know that the United States government officially holds approximately 8,133 metric tons of gold, stored primarily in Fort Knox, West Point, and the New York Federal Reserve vaults. This gold has been on the government's books at $42.22 per ounce since 1973, a price that was already absurdly outdated when it was set, and is now completely detached from reality, given that gold currently trades around $2,000 per ounce. This accounting quirk means that on paper, the US gold reserves are valued at around $11 billion, but if you mark them to market at current prices, they're actually worth closer to $500 billion. Now imagine the US government passes legislation tomorrow that officially revalues this gold to current market prices suddenly. With the stroke of a pen and some creative accounting, the Treasury has conjured nearly $500 billion in additional assets. They could theoretically use this revaluation to issue new gold-backed bonds, create a stabilization fund, or simply improve the debt-to-asset ratio that credit rating agencies look at when deciding whether to downgrade American debt. The historical precedent for this is striking. In 1933, Franklin Roosevelt devalued the dollar against gold from $20.67 per ounce to $35 per ounce, effectively a 69% devaluation. And this revaluation helped the government service Depression-era debts and recapitalize the Federal Reserve. What Roosevelt did was confiscate private gold holdings, forced everyone to sell their gold to the government at the old price, then immediately revalue gold upward, giving the government a massive windfall. A modern gold revaluation wouldn't require confiscation. The government already holds the gold, but the economic effect would be similar, creating paper wealth out of accounting changes. The danger, of course, is that this would signal to the entire world that America is so desperate to manage its debt that it's resorting to accounting gimmicks, which could actually accelerate the loss of confidence it's trying to prevent. And markets might see through the illusion and recognize that revaluing gold does on debt actually change the fundamental problem that the government spends far more than it collects in taxes. The second strategy is even more radical and builds on the cryptocurrency revolution that most governments initially dismissed as a passing fad. The creation of a sovereign digital dollar or Fed coin that allows the Federal Reserve to implement negative interest rates on cash holdings, effectively forcing citizens to spend or invest their money rather than save it, while simultaneously giving the government unprecedented surveillance and control over every transaction in the economy. Here's why this matters for the debt crisis. One of the fundamental problems facing the US government is that, as debt levels rise, eventually interest payments consume so much of the budget that there is no room for anything else. By some projections, interest payments on the national debt could exceed defense spending within a decade and exceed all discretionary spending combined within 2 decades. The traditional escape valve for governments drowning in debt is inflation. You borrow money today, inflate the currency tomorrow, and pay back your debts with devalued dollars that are worth less in real terms. But inflation is politically toxic, economically destabilizing, and difficult to control once it starts. A digital dollar offers a more sophisticated tool, the ability to set negative interest rates on digital cash, meaning that money sitting in your digital wallet would slowly lose value over time by design, incentivizing immediate spending and investment. This would goosey economic activity, generate more tax revenue, create inflation that erodes the real value of existing debt, and give the Federal Reserve godlike control over the velocity of money in the economy. The historical parallel here is fascinating. In the medieval period, some European rulers would periodically call in all coins and reissue new ones at a lower weight or purity. Pocketing the differences was called debasement, and it's exactly what inflation does, just more slowly and less obviously. A digital dollar with programmable negative interest rates is debasement for the 21st century. Technologically sophisticated but economically equivalent to the Roman emperors reducing the silver content in their China is already piloting a digital yuan with exactly these capabilities, and the European Central Bank is exploring a digital euro. The United States has been slower to move, partly because the dollar's dominance gives it less urgency. But as the debt crisis intensifies, the temptation to deploy this tool will become overwhelming. The shocking part is how few people understand that cryptocurrency technology, which was originally conceived as a libertarian escape from government-controlled money, could actually become the most powerful tool for government control and debt management ever created. The third strategy involves something that sounds like science fiction but is actually being actively discussed in policy circles. Using cryptocurrency as a strategic reserve asset alongside or instead of gold, where the US government accumulates a massive position in Bitcoin, or creates its own sovereign cryptocurrency, then allows or encourages this asset to appreciate in value relative to the dollar, creating paper wealth that can be used to manage debt levels while simultaneously maintaining dollar dominance in day-to-day transactions. This is geopolitical financial engineering at its most sophisticated. Think about the logic. The US government's fundamental problem is that it has too much dollar-denominated debt and not enough tax revenue to service it without borrowing more, creating a debt spiral. Traditional solutions would be to raise taxes, cut spending, or inflate away the debt, all of which are politically difficult and economically painful. But what if the government could acquire an asset that appreciates faster than the debt accumulates? If the US Treasury had quietly accumulated, say, 1 million Bitcoin when they were worth $100 each in 2013, that $100 million investment would now be worth over $40 billion at current prices, a 400-fold return. Now imagine the government acquires a strategic Bitcoin reserve today, maybe by confiscating coins from criminal enterprises, which they already do, or by purchasing them on the open market, or by accepting Bitcoin for tax payments, or by mining Bitcoin using government-controlled energy resources. If Bitcoin continues its historical trajectory and reaches 10 times its current value over the next decade, suddenly the government is sitting on an asset that has appreciated from billions to trillions, providing a cushion against the growing debt. The truly shocking part of this strategy is that it doesn't even require Bitcoin to become the global reserve currency or to replace the dollar. It just requires Bitcoin to continue appreciating relative to the dollar, which could happen precisely because people are losing faith in fiat currencies and fleeing to scarce digital assets. This creates a perverse incentive where the US government could actually benefit from declining confidence in its own currency as long as it holds appreciating alternative assets. It's the equivalent of a homeowner taking out a massive mortgage, then hoping their house appreciates faster than the interest accumulates, except at a national scale with cryptocurrency. The historical precedent is Spain in the 16th century. Spanish conquistadors brought back massive quantities of gold and silver from the New World, temporarily making Spain the richest nation in Europe. But because the influx of precious metals caused inflation, and the Spanish government spent the money faster than it came in, the ultimate result was bankruptcy and decline. The US government buying Bitcoin could follow the same pattern. temporary asset boost that masks underlying fiscal dysfunction, buying time but not solving the fundamental problem. The fourth strategy is perhaps the most Machiavellian, and involves deliberately engineering a cryptocurrency boom and bust cycle where the government covertly encourages retail investors to pile into digital assets, let the bubble inflate, then use regulatory actions to crash the market at a strategically chosen moment, allowing well-connected institutions to buy the wreckage at pennies on the dollar, while creating economic chaos that justifies extraordinary monetary interventions that help manage the debt crisis. This sounds conspiratorial until you understand the history of how governments have used financial markets for strategic purposes. Consider the Bank of England. Founding in 1694, it was explicitly created to help the British government finance wars through debt issuance. And throughout the 18th and 19th centuries, the bank repeatedly orchestrated liquidity crises and market panics that benefited the government and its connected bankers while destroying competitors. Or consider the Plaza Accord of 1985, where the US government coordinated with other major economies to deliberately devalue the dollar and revalue other currencies, particularly the Japanese yen, ultimately contributing to Japan's lost decades of economic stagnation. These weren't market accidents, they were policy decisions with massive consequences. Now, apply this thinking to cryptocurrency. Imagine the SEC and other regulatory agencies adopt a deliberately ambiguous stance toward crypto, neither fully legitimizing it nor shutting it down, creating uncertainty that allows speculative bubbles to form. Retail investors, chasing returns in an era of low interest rates and high inflation, pour money into crypto. The bubble inflates Bitcoin to 100,000, 200,000, even higher. Institutional investors, hedge funds, sovereign wealth funds, all pile in. Then, at a carefully chosen moment, perhaps when the debt crisis is reaching a critical point and the government needs a distraction or justification for emergency measures, regulators suddenly crack down, SEC enforcement actions, treasury sanctions on crypto exchanges, Federal Reserve warnings, maybe even legislation banning certain crypto activities. The market crashes, retail investors lose trillions, but guess who's positioned to buy the wreckage? Government-connected institutions that were tipped off, Treasury-approved buyers, maybe even the government itself through various entities. The crash creates economic turmoil, which gives the Federal Reserve justification to lower interest rates, again, implement more quantitative easing, and buy more government bonds to suppress borrowing costs, all of which help manage the debt crisis. Meanwhile, the government and its allies now control a larger share of the cryptocurrency space, positioning America to dominate whatever the next iteration of digital finance looks like. It's financial warfare disguised as market volatility, and the precedent for it runs throughout history. The fifth strategy involves something that most people don't realize is even possible. The use of gold and cryptocurrency as collateral for special drawing rights or other forms of international lending facilities that allow the US to effectively borrow against its strategic reserves without actually selling them, creating liquidity to service debt while maintaining the fiction that the reserves are untouched. This requires understanding how international finance actually works at the highest levels. The International Monetary Fund operates something called special drawing rights, which is essentially a basket of currencies that countries can use for international transactions and to settle debts with each other. Countries contribute assets to the IMF and receive SDRs in return, which they can then use for various purposes. Now imagine the US negotiates an expansion of the SDR system, or creates a parallel system where gold and cryptocurrency holdings can be deposited as collateral for drawing rights, effectively allowing the government to borrow against these assets without selling them. This is financially sophisticated but conceptually simple. It says the same as taking out a home equity loan where you borrow against the value of your house without selling it. The advantage is that you get liquidity to pay current bills without losing the asset that might appreciate in the future. The disadvantage is that you're adding more debt, and if the collateral loses value, you're in even worse shape. But from a debt management perspective, this strategy is attractive, because it allows the government to tap into the value of its gold and crypto holdings without the political optics of selling strategic reserves, which would signal desperation. Rome did something similar in its later imperial period. The government would confiscate private gold and silver under various pretexts, melt it down to mint new coins with reduced precious metal content, use the new coins to pay soldiers and debts, and pocket the difference. They were essentially borrowing against the confiscated wealth of their citizens, a modern version using gold and crypto. As that collateral is more sophisticated but economically similar, it's converting fixed assets into liquidity to service debt, buying time, delaying the reckoning. The shocking element is that this could be done through international institutions in ways that are opaque to most observers, with the public only finding out years later when historians dig through the archives. The sixth strategy is the most technically complex, and involves using cryptocurrency's programmability to create synthetic assets or derivative instruments that allow the government to hedge its debt exposure, take leveraged positions on dollar strength or weakness, or engage in what's essentially financial engineering at a sovereign level to manipulate the apparent debt-to-GDP ratio or other key metrics that markets watch. This requires understanding that modern cryptocurrency is just digital money. It's programmable money that can be embedded with smart contracts that automatically execute complex financial transactions. Imagine the US Treasury issues special blockchain-based bonds where the repayment terms automatically adjust based on GDP growth, inflation rates, or other economic indicators, effectively making the bonds self-hedging. Or imagine that government creates synthetic positions where it does simultaneously long on appreciating crypto assets and short on depreciating fiat positions, creating a portfolio that profits from the very decline in confidence that's driving the debt crisis. This is the financial equivalent of judo using the force of the problem against itself. The historical precedent here is the rise of derivatives markets in the 1970s and 1980s. Which allowed sophisticated actors to hedge risks in ways that weren't previously possible, but also created systemic fragility that led to events like the 1987 stock market crash and the 2008 financial crisis. Cryptocurrency derivatives could be even more powerful and even more dangerous because they can be programmed to execute automatically without human intervention, creating complex chains of transactions that might cascade in unexpected ways. From a debt management perspective, these tools could allow the government to effectively hide debt off balance sheet, similar to how Enron used special-purpose vehicles to hide losses, except at a national level with the complexity dialed up by orders of magnitude. The shocking realization is that blockchain technology could make sovereign accounting even more opaque rather than more transparent, because the complexity creates camouflage. The seventh and final strategy is perhaps the most disturbing because it involves abandoning any pretense of paying back the debt in real terms and instead using gold and cryptocurrency to create a two-tier monetary system, a stable, asset-backed currency for international settlements and wealthy individuals, and an inflationary fiat currency for domestic transactions and regular citizens, effectively creating a form of financial feudalism where access to real money becomes a privilege of the elite, while everyone else's wealth slowly erodes through inflation. This isn't theoretical, we're already seeing early versions of this system emerge. Wealthy individuals and institutions are increasingly moving into gold, Bitcoin, real estate, and other hard assets as inflation hedges, while ordinary people hold most of their wealth in bank accounts and retirement funds denominated in depreciating fiat currency. The government could formalize this arrangement by creating a gold-backed or crypto-backed international settlement currency for trade with other nations, while keeping the regular dollar for domestic use and slowly inflating it to erode the real value of the debt. This is exactly what Rome did in its final centuries. The government maintained a gold solidus for international trade and to pay the army, while common citizens used debased bronze and copper coins for daily transactions, creating a two-tier system where real value was reserved for the elite and the masses transacted in effectively worthless tokens. The Byzantine Empire continued this system for nearly 1,000 years after Rome fell, maintaining a gold numisma for important transactions while local currencies came and went. A modern version would be technologically more sophisticated but economically identical. The government services its international debts with a stable, asset-backed currency that maintains value, while inflating the domestic currency to reduce the real burden of internal debts like Social Security and Medicare. The citizens holding dollar-denominated savings and pensions would see their wealth slowly eroded, essentially paying an inflation tax that transfers wealth to the government and asset holders. This strategy is shocking not because it says unprecedented. It says exactly what every declining empire has done, but because it represents the abandonment of the social contract that says the government will maintain the value of its currency for all citizens equally. It's a return to a pre-modern system where money has different values depending on who you are, where access to real wealth becomes a function of political and economic power rather than productive work. Now, here is what makes all 7 of these strategies particularly dangerous. They could be implemented simultaneously or in sequence, creating a cascade of interventions that mask the debt crisis for years or even decades, while the underlying problems continue to worsen. Imagine the government revalues gold to improve its balance sheet, launches a digital dollar with negative interest rates to force spending and generate tax revenue, builds a strategic Bitcoin reserve that appreciates in value, engineers a crypto boom and bust cycle to reset the market on favorable terms, uses gold and crypto as collateral for international borrowing, deploys blockchain-based derivatives to hide debt off balance sheet, and gradually transitions to a 2-tier monetary system. Each intervention buys time, creates confusion, shifts the burden, and allows the debt to keep growing while giving the appearance of management and control. This is the modern equivalent of what the Roman Empire did over several centuries. They debased the currency, raised taxes, confiscated private wealth, inflated the money supply, issued new coins, reformed the currency multiple times, and created increasingly complex administrative systems to hide the fact that the empire was fundamentally bankrupt. The process took hundreds of years in Rome's case because communication was slow, economic activity was limited, and people had fewer alternatives. In our interconnected, high-speed digital world, the same process could unfold over decades rather than centuries. But the end result would be similar: a transfer of wealth from creditors and savers to debtors and asset holders, a decline in real living standards for ordinary citizens, and eventually a restructuring of the entire global monetary system. The question isn't whether America's debt crisis will require extraordinary measures. The mathematics make that inevitable. The question is which combination of these strategies the government will deploy, how quickly they'll implement them, and whether the American people will understand what's happening before it's too late to demand alternative. What makes this moment in history so critical is that we're reapproaching what economists call a phase transition, a point where the system's behavior fundamentally changes. For decades, the US has been able to borrow at low interest rates because the dollar is the global reserve. Currency and treasury bonds are considered the safest asset in the world. This creates a virtuous cycle. Low borrowing costs make the debt manageable, which maintains confidence, which keeps borrowing costs low. But there's a point, and we don't know exactly where it is, when the debt becomes so large that the cycle reverses. Rising debt reduces confidence, which increases borrowing costs, which makes the debt grow faster, which further reduces confidence. Once that cycle starts, it's extraordinarily difficult to stop without radical intervention. History shows that empires facing this situation have exactly 3 options. They can implement severe austerity, slashing government spending and raising taxes to balance the budget, which is economically painful and politically suicidal. They can default on their debts, either explicitly by refusing to pay or implicitly through inflation, which destroys the value of the currency and wipes out creditors. Or they can engage in financial innovation and engineering, which is a polite way of saying sophisticated accounting tricks and monetary manipulation to mask the problem and delay the reckoning. Every declining empire has chosen the 3rd option for as long as possible, before being forced into some combination of the first 2. Spain tried to manage its 16th and 17th century debt crises through multiple defaults and currency manipulations before finally accepting decline. France tried increasingly desperate financial innovations throughout the 18th century, before the old order entirely. Britain gradually transitioned from gold standard to fiat currency, while losing its empire and reserve currency status over several decades in the 20th century. The US is now walking the same path, and gold and cryptocurrency are the tools that could allow American policymakers to engineer the most sophisticated delay in history. The ultimate irony is that gold and cryptocurrency were supposed to be alternatives to government-controlled money, safe havens from exactly the kind of debt crisis and currency debasement we're discussing. Gold has been money for thousands of years, precisely because governments could print more of it at will. Bitcoin was explicitly designed to have a fixed supply cap of 21 million coins, making it immune to inflationary money printing. These assets were supposed to protect people from government fiscal irresponsibility, but as we've seen throughout history, governments are remarkably creative at copying controlling, or manipulating even those assets that were designed to constrain government power. The gold standard was supposed to prevent inflation and discipline government spending, but governments abandoned it when it became inconvenient. Gold confiscation in 1933 turned the ultimate private store of value into a government-controlled asset, and now cryptocurrency isn't to be decentralized and government-proof is being eyed as a potential tool for unprecedented government control and surveillance through central bank digital currencies, and as a strategic asset that could be used to mask government insolvency. The pattern is clear. Every tool that humans create to protect wealth eventually becomes a tool that governments use to extract or control wealth. The 7 strategies we've discussed are aberrations or conspiracies theory, the logical evolution of how power and money interact when a dominant empire faces the mathematics of unsustainable debt. Understanding these strategies doesn't necessarily tell you what to do with your own money or how to protect your wealth, but it does give you a framework for interpreting the news, the policy decisions, and the market movements that will define the next decade as America navigates the most consequential debt crisis in its history and potentially in world history given the size of the global economy and the interconnection of modern financial markets. So watch for the signs, watch for legislation that revalues gold or creates strategic crypto reserves. Watch for the rollout of digital dollars with new capabilities. Watch for regulatory crackdowns on crypto that seem designed to crash the market. Watch for new international lending facilities that use novel forms of collateral. Watch for increasingly complex blockchain-based governance securities, and watch for the gradual emergence of a 2-tier system where asset-backed money is reserved for international settlements while inflatable currency is used domestically. These won't happen all at once, and they won't be announced as we're reusing gold and crypto to mask the debt crisis. They'll be framed as modernization, innovation, stability measures, and technical improvements to the financial system. But if you understand the underlying logic, you'll recognize them for what they are, the desperate improvisations of an empire trying to maintain its position while the mathematics of its debt spiral play out. Every empire in history has faced this moment, and every empire has made similar choices, and every empire has ultimately been unable to prevent the restructuring that must eventually come. The debt always wins in the end, one way or another. But gold and cryptocurrency could allow America to delay that day of reckoning longer than any empire before it, creating a decade or more of apparent stability while the foundations continue to crumble. That's not a prediction of immediate collapse, a prediction of sophisticated delay tactics that could maintain the illusion of American economic dominance for longer than the fundamentals would suggest is possible, followed eventually by a restructuring that will reshape global finance in ways we can't fully anticipate. The pattern is clear, the tools are ready, the incentives are aligned, and the mathematics are inexorable. Which means the question is not whether these strategies will be deployed, but when and how effectively, and whether anyone will understand what's happening in real time, or whether it will only become clear in retrospect when historians write about the early 21st century the way we now write about the fall of Rome. If you want to understand the financial forces reshaping our world before they reshape your wallet, you might want to subscribe to the Empire Economy.